You do not need a massive bankroll to trade successfully. But when people online tell you that a small account is a quick ticket to wealth, 95% of them are lying. Trading a small account is harder than trading $1 million. The math of the market actively works against tiny capital from the very start. To survive this, you have to follow a specific, rigid protocol. And if you ignore what I call rule number 3, you are guaranteeing total capital destruction. Standard trading advice is built for large portfolios that can absorb high fees and wide price swings. For a sub-$1,000 account, these traditional rules ensure that commissions and volatility consume your balance before your strategy can even begin to work. We have all seen how this usually starts. You get home from a long shift, pull together a few $100s, and spot a trending stock or crypto asset surging online. Greed takes over. You buy an oversized position to capture the move. Instantly, the market reverses. You panic, sell at a loss, and then jump right back in trying to win the money back. This is the small account paradox. When your balance is tiny, making a 5% return translates to just a few dollars. That lack of scale forces you to take massive, illogical risks just to make the profit feel significant. When a beginner's account hits zero, it happens because emotional desperation forces them into gambling rather than calculating. Professional traders understand that when capital is limited, absolute survival must come before aggressive growth. Take a look at this chart mapping out a typical drawdown. If you start with $1,000 and lose 50%, you are down to $500. But to recover your original baseline, you must execute a grueling 100% climb just to break even. You cannot achieve that recovery or scale a small balance by parking your money in slow-moving blue-chip stocks. You need asset velocity. Asset velocity means targeting high-momentum setups that move 5 to 10% in a single day. You enter the trade, grab your profit, and exit within a 1 to 5 day window to quickly compound that capital. By moving quickly, trading becomes a clinical business transaction. You eliminate the emotional urge to hold on to an investment, and you keep your capital moving. High-velocity trading will wipe you out if you do not implement rule number 3, the kill switch. This is a hard risk cap on your account. You configure your broker to automatically trigger a stop-loss order if a single trade drops by 1 or 2%. No exceptions. This automated rule removes hope from your strategy. It slices off a losing trade instantly, long before a minor dip turns into a devastating emotional crash. Keeping losses microscopic allows you to be wrong half the time while still pulling steady profits from the market. Strict risk management provides the control needed to maintain power over your account. Once you have survival locked down, you can start scaling. The way to do that relies on a mathematical engine that trading algorithms use constantly, but retail traders rarely utilize. Forget the massive home run trade. The true path to wealth relies on 3 predictable setups a month, aiming for a 10% profit. Early on, these blocks of profit seem small, but as the sequence continues, the math accelerates, bending upward into massive wealth. True wealth is extracted from the markets through predictable, emotionless systems. Boring advice is what actually creates millionaires. Small accounts function as psychological training grounds. They are not intended to make you wealthy overnight. Think of it as a stress test. If you cannot manage $1,000 calmly, you are psychologically incapable of managing $100,000. Professional trading is built on the rigid business principles of consistency and risk control. It operates completely divorced from the adrenaline-fueled desperation of a casino. The market is a machine specifically designed to punish desperate money. You will always see people posting wild, lucky gains, and the temptation to chase them will never disappear. Accounts collapse when traders lack the discipline to trade small balances correctly. So ask yourself, what is actually harder, making the money or keeping your emotions under control?